All right, thank you and welcome everyone to our inaugural ALTA Insights webinar. It's our first webinar in our new ALTA Insights series. My name is Steve Gottheim. I'm ALTA's General Counsel, and with me today I've got two great guests who are going to kind of walk us through everything people need to know about the PPP program, the Paycheck Protection Program, and how the loan forgiveness works. And I've got Allison Baker and Meredith Boylan from the Venable Law Firm who are going to serve as our experts today. ALTA Insights is our new webinar brand, as I said earlier, and it's part of our mission at ALTA is to provide you as members all the information and education you need to run your business and really stay on the leading edge of the market to make sure you're ahead of the curve on industry trends. Given all that's going on with the country these days and in our economy, education and this information is now needed more than ever, and so we developed ALTA Insights to really kind of get you in a position to hear from leaders inside and outside the industry about the topics that are really going to impact your business right now and in the near future. Our webinar today, How to Plan for PPP Loan Forgiveness, is particularly relevant. The Paycheck Protection Program is the central pillar of our economic response as a country to COVID-19. These loans were designed to help small businesses stay afloat and retain staff during the stay-at-home orders that we've all just started to come out of. If businesses spent the money primarily on payroll and retained or rehired their staff, they could get up to the full amount of their loan forgiven, and so these could become essentially, basically grants as opposed to loans. When we did a program in early April, 2,000 of you joined us to really learn all about the details of how to apply for these loans, and certainly that information was really timely then, as we know a large number of title companies applied. Almost 80% of title companies applied for PPP loans throughout this program. And so now as we enter phase 2 of the PPP program, where people are starting to look at how do they get that loan forgiven, we really wanted to bring you this follow-up in that series. And so I'm grateful to have our two speakers here who have really been focused on the PPP program since day one, advising clients and about all the intricacies of these rules, including a lot of the ones that are changing as we speak, and guidance that is hopefully soon to be forthcoming. Allison Baker is a partner at the Venable Law Firm. She chairs the financial services and practice and co-chairs the consumer financial services practice. Before joining Venable, Allison was an enforcement attorney at everybody's favorite four letters, the CFPB, and also was in the tax division at the Department of Justice. She's a noted expert on areas of consumer financial law and guides businesses through investigations with all of the different federal agencies. So we are grateful to have Allison here. Joining her today is Meredith Boylan, also a partner at Venable. Meredith's an experienced trial attorney who represents corporate and individual clients in federal and state regulatory investigations and related litigation. We are lucky to have both Allison and Meredith here to really provide a great overview of this topic and hopefully answer all of your burning questions, or at least take away the questions that they can't answer, and then we will pressure Secretary Mnuchin to answer them sometime soon. Before we get started, just a couple of housekeeping items of note. All participants' lines are muted for today's presentation. If at any time you do have a question throughout the presentation, you can do that by submitting it through the chat or question feature on the right-hand side of your screen. We'll save about 15 minutes or so for questions at the end, and we will try to get to as many as possible. As an added benefit, today's presentation is being recorded. You will get access to that recording after the show today, and it'll also be posted on our website. We've got handouts on the side as well, including an FAQ and a copy of today's PowerPoint for you to take notes on at home if you'd like to do that route. So with that, let's get started. So part of, as we talked about, the PPP program is really part of the central pillar of kind of our economic response to the COVID-19 crisis. And you can see on the screen, so far there have been 3 phases of stimulus packages. The first phase really dealing with some healthcare and vaccine development funding. The second phase dealing with paid sick leave and expanding FMLA leave. And then the third phase, the CARES Act, is the $2 trillion stimulus that we've been talking about for 3 months. Which really dealt with direct payments to folks, the $1,200 economic payments, increasing unemployment insurance payments, the $600 bonus increase on unemployment payments for folks that is soon to run out soon. And then as we're really going to focus today on loans to small businesses to help them stay afloat, the Paycheck Protection Program. We do know that there's talks in Congress of further programs, whether it's a phase 4 is kind of the current discussion, and that's something that we're looking at as something to focus on in really the late June, more likely July timeframe if something is going to come together. So as we talked about the Paycheck Protection Program, this is just a basic overview of the program. Again, these are loans for businesses with 500 or fewer employees. In the title industry, either it's 500 or fewer employees or $12 million or less in revenue. That equals about 98% of title insurance companies were eligible for PPP loans. You could get up to 250% of your average monthly payroll cost, and if you follow the rules that we talked about today, you can get almost 100% of that those loan proceeds forgiven. Last week, Congress and passed and the president signed the Paycheck Protection Program Flexibility Act, the PPPFA. You can see here a couple of major changes that are just worth noting. We'll go into more detail into some of these as we get into the rules. But the big, kind of the big ones here are reducing the amount of money that had to be spent on payroll from 75% to 60%. We'll have a couple of questions. I know Meredith has got some ideas, some unanswered questions that she'll want to talk about on that subject. Extending the period of time in which you could use these funds. So originally, PPP loans, you had to use all of your funds that you wanted to get forgiven within 8 weeks of having the loan funded. That's been extended out to 24 months. Some more deadlines for pushing some of the deadlines for rehiring employees. But again, just a lot of new flexibility to hopefully make it easier for you all to get up to 100% of your loans forgiven. So we will go into a little bit more detail about kind of how all of these play out in the next few slides. Before we jump into the detail here, just some really good basic facts for everybody. The first round of PPP funding ran out in about a week and a half or so, of that $350 billion that was set aside. Congress did top it off and add another $300 billion or so into the fund, and there is still money left over. So if you are a small business that is dealing with some financial strain or expected some financial strain throughout the rest of this year, talk to your bank and really start to consider going for a PPP loan. There's still $130 billion left available to it. Back in late April, ALTA did a survey of our members about kind of how your businesses are changing related to COVID-19. And one of our questions really did deal with PPP funding. And at that time, this was right before the second round of money was put into the program. Almost 40% of you had already gotten approved for a loan and received funding. About another 30 or so percent, 31 or so percent had applied but not quite gotten funding yet. Either you hadn't been approved yet, or you're waiting for approval, or hadn't got your funds yet. So we know a large percentage of ALTA members, and these numbers have only gone up over the last few weeks, have taken advantage of this critical funding to help shore up your economic situation throughout this crisis. As we look at just the total amount of money lent out across a whole bunch of industries, so the sectors that have gotten the most money in the PPP program, the healthcare sector, but the second one, the professional, scientific, and technical services sector, that's the sector where title insurance companies and law firms are covered. And so you can see law firms and title companies have been the second largest recipient in that grouping of these funds. So hopefully it kind of shows exactly where that need was in this space. We also looked at kind of how people are changing their employment practices back in April in our survey. As we know, title companies were very fortunate to be considered essential businesses, and so many of you were able to keep your doors open and keep your staff working, especially with the boom in refinances that kind of covered a couple of the last few months as we've gotten through these stay-at-home orders. And so most title companies have not had back in April had to make changes to their staffing requirements. And so we can see just, there are some that have had to reduce hours, some 11% that laid off staff. All of that will be critical to think about as we get into some of the details about loan forgiveness and how to maximize the amount of money that you don't have to repay in these PPP loans. So with that, I am now going to turn it over to Allison and Meredith to kind of go through and really walk us through the steps of PPP loan forgiveness.
Thank you, Steve, for the introduction. I'm Allison Baker, and Meredith and I have been spending the last 2.5 months pretty much incessantly advising companies and small businesses across the United States about the PPP loan program, all aspects of it, including forgiveness, and now this latest, the PPPFA, Paycheck Protection Program Flexibility Act. And so today we're gonna talk a bit about the loan forgiveness component of that and what you need to be thinking about as you move forward with loan forgiveness. So I guess if we could advance to the next slide. So basically, as of last week, the Paycheck Protection Program Flexibility Act added some additional features. So businesses are eligible to have 100% of the principal and any accrued interest forgiven on this loan, functionally converting it into a grant, which of course is what has made it so appealing to so many different businesses across the United States. First of all, there's a number of different rules around that forgiveness. Number one, if you seek forgiveness, you have to use the proceeds of the loan for permissible purposes specific to forgiveness. So number one, on payroll, number two, on rent and utilities, and number three, also on mortgage interest. So those are the permissible purposes for which you can seek forgiveness. Originally, the timeline for the forgiveness program was 8 weeks. It's now been extended to 24 weeks after the disbursement of the loan, or December 31st, 2020, whichever's earlier. So basically, it won't go out past December 31st, 2020. And in addition, there's been a couple of other changes to the program, which we're going to talk about in a moment. In order to ensure that you're eligible to receive the maximum amount of forgiveness, ideally all of it, one of the things you really need to make sure is during the relevant time period, whether you're talking about 24 weeks or you revert back to the original 8 weeks, and we'll talk about that reverting back in a moment, you have to make sure that the number of employees that you have on payroll, the number of average monthly full-time employees, doesn't decline, doesn't dip below a number, and that number is 1 or 2 points in time. So either the number of full-time employees that your business had between February 15th and June 30th of 2019, or the number of full-time employees that your business had between January 1, 2020 and February 29th, 2020. So you can choose either of those points in time when you're looking at total FTEs for either that 24-week period, or if you choose and you had the loan prior to last week, the 8-week period. So those are some of the basics. If we can go to the next slide, and Meredith will walk us through some of the other components of this.
Sure. So as Allison was mentioning, there is an opportunity to, in an ideal world, receive 100% forgiveness. Given the complexities of your businesses and the realities that are presented through the COVID-19 crisis, you may not end up getting 100% forgiveness, unfortunately. And so in that case, the amount of the loan, the unforgiven amount, will need to be repaid. The statute and the subsequent guidance initially stated that the loan would be a 1-year term of maturity, 2-year term of maturity at 1% interest. The PPPFA has extended that to 5 years maturity, but I believe as written that rule applies to newly issued loans. However, there is an opportunity for borrowers and their lenders to come to a mutually agreed upon term if both parties want to pursue the 5-year term instead. But the 1% interest rate remains the same. So back to the forgiveness itself. As Allison mentioned, there are certain ways that you can spend this money in order to qualify for forgiveness. And payroll costs is defined quite broadly. Some of the examples are listed below. And it includes at its most basic, the salaries and wages that you pay to your employees. But it can also pull in certain benefits payments, severance payments, local tax payments. And subsequent guidance has also explained that you could bring bonus payments in and hazard pay as well. So those are some options that you may want to think about if those apply to your business. It also allows you to seek forgiveness for interest payments on mortgage obligations, and the subsequent guidance through the application and forgiveness guidance that came out after the application was released explain that mortgage obligations can be on real or personal property. So that is perhaps a little bit broader than maybe originally contemplated in the statute. And then also rent and certain utilities, which are spelled out in the statute itself.
Can I, so one of the things that has been a bit of a source of confusion that Meredith and I have encountered is the costs that are eligible for forgiveness are slightly different than the way that you're able to use the loan proceeds. So it's contemplated that you could use the loan proceeds as well for existing debt obligations. And I suspect what's contemplated, and candidly, the rules aren't super clear on this, is that if you used the loan proceeds for existing debt obligations, not including mortgage interest or rent, that component of your loan proceeds would not be eligible for forgiveness. So I note this because it's something that comes up in conversation sometimes. So mortgage interest, rent, utilities are the eligible expenses in addition to payroll for forgiveness. They have to concern obligations that predate February 15th. They are not only specific to real property, but for example, if you lease office equipment, you can seek to have that forgiven. That's an eligible expense. But I wanted to make that distinction because inevitably somebody will have that question because it's a little bit of a disconnect between what you can use the money for and what you can get it forgiven, what can get forgiven. So we just wanted to clear that up. Go to the next slide, please. Thank you.
And
yeah,
following on that discussion, the money can't be used for excess compensation over $100,000. So this doesn't mean that employees who make more than $100,000 are cut out of benefiting from the program, or that you can't seek forgiveness for employees who make over $100,000, but there is a cap on the amount of compensation you'll be able to seek for those more highly compensated employees. In addition, the employees have to reside here in the United States, and there are certain exclusions for leave wages that are covered by other aspects of the legislation that's been passed. And this is, oh, sorry, Allison.
No, go ahead. I'll weigh in after.
Okay. This is one of the newer developments with the PPPFA, which is the statute as currently written states that at least 60% of the PPP loan proceeds shall be used for payroll costs. That modifies an interim final rule that was previously released that spoke of 75% being the threshold. And that interim final rule itself modified the statute, which didn't have any limitations on how the funds had to be utilized as far as what percentage had to be attributed to payroll costs. The statute, the PPPFA that came out last week, as currently written, indicates or suggests that the 60% use of proceeds for payroll costs is a threshold that you need to meet in order to achieve forgiveness. However, it's expected that the guidance itself will refine that and will state that you can be eligible for partial loan forgiveness even if you don't meet that threshold, subject to at least 60% of the loan forgiveness amount having been used for payroll costs. So it's going to be more of a proportional analysis than a hard and fast cliff that you need to reach in order to get in the door for forgiveness.
And I think that, I think that this is particularly beneficial to a lot of the folks probably listening on this phone call, because it strikes me that the 75% threshold didn't necessarily assist companies that maybe have fewer employees but higher other costs. So you could see a scenario, for example, if you're in a high rent jurisdiction and you may be paying a lot in rent in relation to, if you're in New York City or where we live in Washington, rent's expensive. You may only have 4 or 5 employees, but you may have really high rent costs. And so this 60% reduction, as opposed to it being at 75, is a real, I think, benefit for a lot of companies that have, more capital intense expenses and maybe fewer labor intense expenses in relation to certain, for example, a restaurant, which may have more employees and less rent, depending on where it's located. I think that's really helpful. The other thing that's extremely helpful here is it makes it clear that this is proportional and not a threshold. So the guidance that we expect to come out will say, look, if you don't hit the 60-40 threshold, the amount that gets forgiven has to be in a 60-40 percentage, but it's contemplated that it's not all or nothing, which is what Meredith was saying. And I think these two additions to the existing rule and law are particularly helpful to our audience today. So the covered period, the Paycheck Protection Flexibility Act changes what's called the covered period, and what the covered period functionally is the timeline when the act itself is applicable, and it covers the kind of scoping of what is being reviewed or looked at for purposes of forgiveness eligibility. That period was originally ending on June 30th. Suffice to say, when you look out at the world and you realize a lot of companies aren't quite up and running because the pandemic has gone on longer than I think people expected in March when the initial CARES Act was passed, it extended the date to December 31st, 2020. So now the relevant covered period goes to December 31st, 2020. But what it's expected to be, and we're looking right now at a piece of legislation that may also result in a second rounding of PPP, but right now it appears that you basically have to have received your PPP loan before June 30th, but you can continue to make expenses and or have your eligible forgiveness period looked at through December 31st. So it's an ideal situation, for example, if you're a business and maybe you're not up and running fully yet by June 30th, the hope is you will be by December 31st. And so you're not in a situation where you're having to spend money to necessarily keep a business operating when, as a practical matter, you may not yet have the customers that you need or the relevant business operations that you need. And so this captures a situation where that timeline goes out past June 30th. It also allows for a forgiveness period that goes past 8 weeks. And this is what we were talking about at the very beginning of this section. Originally, the Paycheck Protection Program said 8 weeks. So the operative timeline was 8 weeks from the date of funding. So the day your loan is funded, counting out 8 weeks, was the timeline that was relevant for looking at the numbers of full-time employees that you had, the ratio of your expenses, now 60-40, previously 75-25. That was an operative 8 weeks. That 8-week period has been extended to 24 weeks, which is good news. It's 6 months. So it gives you an opportunity to look and to use this funding and the forgiveness timeline out to 24 weeks. Now, if you received the loan prior to the Paycheck Protection Flexibility Act, which was passed last week, you can revert to the 8-week period. So we've talked to a lot of people who've said, look, I've used the loan money already. I've spent it. I'm in week 7. And I pretty much have spent all of the money on my payroll. I've spent the requisite proportion on my rent, and I don't need the 24 weeks. Can I revert to 8 weeks? And the answer is yes, you can. It's expected that you'll be able to make an application for forgiveness at the end of the 8-week period, or you can select the 24-week period if you're in a position to say that you had the loan before last week when this new act was passed. So I think it's in general a really good situation. One thing that we don't yet know the answer to, and we're hopeful that we'll get an answer to this, because I bet as I'm saying this, there's a lot of people asking themselves, well, what if I'm somewhere between 8 weeks and 24 weeks? What if I use the money in 14 weeks? Can I apply in week 15 for forgiveness? Candidly, and I know Meredith can weigh in on this as well, because we were literally having this conversation right before this webinar started. Candidly, we don't yet know what that looks like. It doesn't contemplate, as written right now, the statute and the rules that are in place, Don't contemplate a scenario where you're not applying for forgiveness at the end of 8 weeks or at the end of 24 weeks, but that may change and there may be some wiggle room in between. Candidly, my hope is that there is, because I think a lot of companies are going to be in a situation where they want to get that forgiveness at week 14, not necessarily week 24. And Meredith, I don't know if you have any better line of sight into what the guidance is at the moment, but we're, I think, waiting on more.
Yeah, we're definitely waiting on the guidance, but I also think, you know, again, aside from being reasonable and practical from a borrower perspective to allow people to apply for forgiveness once they've exhausted the funds, our suspicion is that the banks would also appreciate having a staggered forgiveness application cycle rather than being flooded with, you know, many applications on December 31st or Happy New Year. So it still is to be seen as to how this will all play out, but that seems like a pretty one of those areas that we would hope would be clarified, because it definitely is a question that we've been receiving daily.
Yeah, and that's a great point about banks not being flooded with applications. The other question is, of course, you know, the forgiveness application itself, I think, as everyone on this phone knows, is handled at the initial stage through a bank. So banks are conceived of as the gatekeepers, and I can't imagine that they're thrilled to be getting deluged with a lot of forgiveness applications all at once. So hopefully there will be some staggering in the rule. And obviously, as we learn more, we'll keep everyone on this call updated through Steve. We'll send him our updates to what we understand to be the rule and the law, and he can circulate that as that makes sense. If we can go to the next slide. If you want to start reductions to loan forgiveness, or.
Sure. So this is one of those areas where it certainly continues to evolve, but the baseline rule still exists in one shape or form to this day, which is the forgiveness calculation at its most basic is going to be susceptible to being reduced if there's been a reduction in full-time employee headcount, or in, you know, substantial 25% or more salary reductions for employees who made less than $100,000 a year. And you know, with respect to the FTE headcount formula, and again, this may shift somewhat as the application evolves and the statute evolves, but the expectation is that the SBA and your lender are going to look at the number of employees, full-time employees, and there's a whole calculation on how you figure out who a full-time employee is. They're going to look at that number during your covered period, during your period where you've had the loan, and they're going to compare that to a look-back period from either earlier in 2020, pre-pandemic, or a period in 2019. And if you have fewer employees during your covered period than you did during one of those look-back periods, there's a, you know, the presumption is that there would be some sort of proportional reduction in proportion to that headcount reduction calculation. We're going to talk some more about that, though, because there are some noteworthy exceptions to that. Similarly, with respect to reductions in payroll, they're going to look at an employee by employee level to see if, you know, an employee who made $70,000 in 2019 now makes $30,000, and if that is the case, there's going to be a proportional reduction as well for those employees who've experienced these fairly substantial pay cuts. Steve, if you could flip to the next slide, please. But there are ways to get around the potential for reduction here. One is to restore the employee headcount, or to restore the salary reductions. By now it states December 31, 2020. It previously was June 30th, 2020. It's unclear what I was just discussing this yesterday with a colleague, which, you know, what does it mean to restore salary? Does that mean on December 31st, if you bump someone back up to $70,000 a year, are you good to go after having reduced their salary to $30,000 a year for the better portion of the year? The guidance isn't clear. As written, it would suggest that that's the interpretation, but that's one of those points that I think as applications start coming in, that question will come up. And so I would expect that we'll see maybe an FAQ or an IFR that further fleshes out that issue. And then with respect to the head count calculation, there's been a lot of development around that notion. You know, if you had 100 employees on February 15th and you only have 50 now, but some employees, you know, you ask them to come back, but their unemployment insurance is better than their salary might be, they'd rather stay home. How do you account for all of these nuances in managing your head count? And so the statute and the rules around it have definitely evolved to capture some of these thornier questions with respect to employees. And so if we could just click to the next slide, I think that lays out some of them. One of the opportunities now under the new PPPFA is to show that you attempted to hire somebody back, but you weren't able to, and you also weren't able to find someone who is similarly qualified. How they'll measure that, you know, a lot of these issues are good faith based, and so, you know, I think one of our recommendations to our clients is to just document everything as you're going through, and certainly with respect to these employment reduction questions. And I don't think it's on this slide, but one other point to just point out is if you had to fire someone for cause, that's not supposed to affect your proportional FTE number. However, you're going to have to show documentation if asked that demonstrates why that employee was fired for cause. Similarly, if an employee voluntarily resigned or voluntarily reduced his or her hours, you'll be expected, if asked, to be able to demonstrate that that truly was a voluntary reduction. The second or the number 2 bullet point at the bottom here, I think is really interesting and potentially really beneficial to a lot of businesses, particularly businesses that have customer-facing operations, is that the PPPFA includes an opportunity to an exception for the reduction provision if you're able to demonstrate that you had an inability to return to the same level of business activity that you experienced before February 15th, 2020, due to compliance with health and safety guidance issued by CDC, HHS, or OSHA. So that I think for a lot of businesses, and I don't know about so much here, but certainly for businesses that operate in a setting where you're expected to sit across the table from someone or across the counter from someone and help them, but you've been unable to due to social distancing requirements or other requirements that require you to keep separate from the public, that could be very beneficial. And again, it's a good faith certification. So that's one of those situations where you're going to probably want to document what protocols you put in place as a result of the federal guidance. But if you can show that, it could be a potentially helpful way to help your forgiveness number.
And if we can, so the next slide concerns a question that we anticipate, you know, a lot of companies might get, which is, my business tried to rehire workers, but some of our furloughed workers did not return and we can't replace them. Are we still eligible for forgiveness? And the answer is yes, if you have documentation along the lines of what Meredith was just saying, that you basically work to try to rehire this employee to no avail, and that you are not able to hire a similarly qualified employee for this unfilled position by December 31st. And as Meredith was just saying, or if for some other reason your business is still not able to return to the same level of workforce that it had been at prior to February 15th, 2020, which is kind of considered the day that the pandemic started, if you will, for purposes of this component of the law. If you can show that that's a function of certain guidance from OSHA or the CDC, you should be okay. And I want to stress something here. A lot of the guidance around social distancing protocols are state-based, they're not federal agency-based. And unfortunately, as this rule and law is currently written, it only contemplates federal-based guidance as being a basis for asserting that you aren't able to return to your regular levels of productivity and workforce numbers, if you will, pre-February 15th, based on guidance from the CDC or OSHA, which are both federal agencies. So you would definitely want to tether any argument you make to that to your understanding of guidance from those agencies and how those agencies' guidance have affected and impacted your business decisions here. I think that's a really important point, because a lot of companies we've spoken to have said, well, you know, the social distance requirements or the shelter in place requirements in California prevent me from ramping back up. And that may be true, but the shelter in place requirements specific to California alone aren't going to be adequate, at least sitting here right now. And that may change with some additional rules, but sitting here right now, those shelter in place guidance alone that are state specific won't be adequate here. So you do need to tether any decision you make to guidelines from a federal agency, including CDC or OSHA. And so we expect that these questions will continue to be front and center in a lot of people's minds, because unfortunately, a lot of businesses, even with the PPP, aren't going to be able to rehire everybody that they may have laid off or furloughed during this time. I think and do I have to rehire the exact same worker to be eligible for forgiveness? So we get this question a lot as well. You do not. What the application contemplates is that you look at the number of full-time employees during the operative period of either 8 weeks, if you want to use the first period, or 24 weeks. And you compare the number of average monthly full-time employees against, as Meredith was saying earlier, one of two timelines, either the average FTEs that you had between February 15th and June 30th of 2019, or the average monthly FTEs that you had between January 1st, 2020 and February 29th, 2020. So it doesn't have to be the exact same person. It just has to be the same FTEs. Having said that, obviously, if you try to rehire a person and you're not able to rehire that person and you can't find an adequate replacement per the slide right before this, you can document that as a reason for why you're not back up to the same levels of FTEs. So that's the way that this is all supposed to fit together based on the rules in place right now. So I wanted to speak a bit, Meredith and I, about the loan forgiveness application itself. So a few things. It's contemplated that at the end of the requisite period, so right now either 8 weeks or 24 weeks, borrowers would make an application to their bank for forgiveness. There is an application that's been published on the Treasury website. You know, our working assumption is that that's more or less the application that banks are going to be using. We expect that that application is going to be amended slightly to capture the Paycheck Protection Flexibility Act components. But basically, the application requests that you provide certain documentation to establish the way that you use the loan proceeds during the operative period of time in order to show how and why you're eligible to have all or some of your loan forgiven. So for example, payroll expenses, you'd want to show payroll logs. You probably, although if you use the 24-week period, you may have IRS filings, but if you use the 8-week period, you may not. But any kind of filings that you do with the IRS that might tend to show your payroll and how much payroll, because you're paying payroll taxes, you know, so if you reverse engineer that, it would show your payroll numbers. Your payroll logs are absolutely something you should use from a payroll service if you use that. Any kind of bank statements that would tend to show the way that you track the money from the receipt of the loan proceeds to the use of those loan proceeds for one of the eligible expenses. Any kind of receipts that might show your expenses around mortgage interest or lease payments or rent payments and or utilities. You have to show specifically for non-payroll expenses, you know, any kind of amortization schedule, receipts, as I was saying, of eligible mortgage interest, any kind of leasing agreement that would tend to show that you're that you have an obligation to make this loan payment for rent, for example, during the operative period of time. And you want to basically start putting all of these papers together, especially if you're on the 8-week program and you want to apply at the end of 8 weeks, for a few reasons. One, the banks are going to be the gatekeeper here. And so the loan application itself, the forgiveness application itself, contemplates these documents being used to support your application. But the banks are also going to be the gatekeeper. And as we all know, they're going to be under a lot of pressure to make sure that any loan forgiveness application that they bless is adequate, and you can substantiate all of the money that you've spent, and you can show that the money that was spent correctly on the right expenses in the right proportion of, at least 60% on payroll, no more than 40% on other expenses. So it's very important that you have this documentation. Something else that we've stressed a lot is being able to show that the loan proceeds you received were in fact used in some direct way for what you say they were used for. So bank statements, or if you segregated your loan proceeds, which is obviously ideal, that is not incorporated them into your larger operating business account. And you can show that, we got a $2 million loan, it went into bank account B. Bank account B for 24 weeks was used to fund our payroll. Here's proof of that. Those are the kinds of documentation, that's the kind of paperwork that we expect you should be compiling, not only because the application suggests that, but because we expect banks are going to be really looking at that and expecting that. And there isn't a ton of guidance out there for how banks should be addressing the forgiveness application at this moment. So there's going to be a lot of interest on the bank's end of making sure that they get this right, and that they're not making decisions about forgiveness in the first instance that could inure to them in a way that creates more risk. So they're going to want to be careful. You're going to want to be careful about that. The application then, you give it to your bank then gives it to the SBA. There's a 60-day period of time when the SBA and the bank make a decision about your forgiveness eligibility. If we can go to the next slide and talk a bit more about this process. And Meredith, if you want to maybe, give a little bit more specifics around the mechanics of how you think about qualifying here.
Sure. So, a lot of the information, that you're going to need to provide is what you would expect. It's more routine information, just housekeeping type data that the SBA is going to need and the bank to track your loan forgiveness application along with the loan itself. So your SBA loan number, the amount that you received. I think this is interesting, and I don't know if it's just a demographic question, but they're looking at the number of employees you had at the time you applied compared to the number of employees you have at the time you apply for forgiveness. And that's so those are just informational data points. And that front page of the application, that's different than your look back calculation that you're going to have to work through to determine your forgiveness amount. But also the date that your PPP loan was dispersed. And of course that ties to your covered period, right? So the subsequent guidance had explained that the 8 weeks and presumably now the 24 weeks is calculated from the date that you get your funds onward. And then again, you're going to need to back up. There's certain documentation that you're going to need to provide at the time you apply for forgiveness. And those are the payroll records that Allison was talking about. And then there's certain information that you're going to have to keep on file for 6 years to have in case of questions going forward. And maybe if we can flip to the next slide, that kind of ties into the next slide, which is there's been a lot of ups and downs over the last several weeks about what type of scrutiny is the SBA going to apply to these the loans themselves and the forgiveness that the businesses are seeking for those loans. So my understanding is that probably the majority of people on this call are looking at loans that are under $2 million. But that $2 million number, as the earlier slide showed, is kind of like the a magic number for the SBA, in that they've announced an intent to give a lot of scrutiny to loans that are larger, those over $2 million loans. However, they stated that they can review any loan, and it's within their discretion as to which loans they are going to look at, and that review can go back to the inception of the loan. Did you initially calculate your loan amount correctly, all the way till the end of the loan, which is, did you correctly calculate your forgiveness amount and everything in between? Did you use the proceeds the right way? And so that ties into this notion that you should keep your documents, keep your folder, keep it together, keep it for 6 years, make sure your house is in order. Any memos that you may have prepared along the way that explained why you needed the loan, board resolutions, all of those types of corporate documents that set forth the rationale for taking the loan in the first instance, and then how the loan was used and how if you're required to show your work on how you came to your forgiveness amount, that you have all of that documentation as well. That also covers your, as we were speaking of earlier, your documentation around employees who stayed, who went, who wasn't able to come back, who didn't want to come back, conditions, economic conditions that didn't allow you to bring everybody back because you just weren't able to restore your business due to COVID restrictions. There is a process in place that if for whatever reason the SBA believes that a forgiveness amount is not appropriate, the way that it's written in the follow-on rules is that it's not just you get a decision and that's it. There is contemplated to be a give and take between the SBA, the lender, and the borrower. So if it's because a piece of documentation is missing, the borrower should be given the opportunity to produce that documentation. On the flip side, if the SBA asks for a piece of documentation and the borrower doesn't produce it, that could negatively affect your ability to get forgiveness. And we're still waiting to get a more formal, fleshed out description of how any sort of formal appeal process will work if ultimately you go through this initial review period and the answer is still no, you're not going to get your loan forgiven. It looks like the SBA is contemplating that there would be an opportunity for a more formal reconsideration request to that decision, but that has not been laid out yet, the protocols around that.
So one other thing I want to note is the main way that the SBA through the bank that you apply through is going to have access to your loan application and also access to decisions around eligibility in the first instance is through the forgiveness process. So all the things that Meredith was just telling you about, documentation that I was discussing about documentation, they don't just inform the contours of of your forgiveness application. They also inform any inquiry or analysis that the SBA may choose to do or audit that the SBA may choose to conduct of your application. As you know, the SBA has said in guidance that it intends to audit any loan that's more than $2 million. And we expect that audit process will probably most likely happen not only through forgiveness, but predominantly through the forgiveness process, as it would seem to be the most obvious way for the SBA to have access to your documents. So being meticulous about documentation and how you used money and how you made eligibility determinations on the front end are, these are all really important things to be thinking about as you move forward. The question we have up on the screen is kind of an anticipated frequently asked question. Once I apply for forgiveness, how long does the bank have to respond to my application? As it's written now, it's 60 days. So the lender has 60 days to issue a decision to the SBA about forgiveness, and that's really done kind of together with the SBA and the lender. They basically look at your materials and they say, okay, we think this loan is eligible for forgiveness. And then the SBA in turn remits to the lender the money that was loaned to the borrower. So, and that's a 90-day process. And what we don't yet know is whether or not that 90-day process, so the 60 days plus the 90 days, in turn means that the borrower's loan is formally forgiven at the end of that 90 days, or if the borrower's loan is forgiven sometime before then. But presumably, in terms of the remittance back to the bank, the expectation is that it will be 60 days for a determination about forgiveness to be made. And then the kind of final forgiveness component, meaning you're no longer on the hook for the loan, if you will will come after the bank has received from the SBA the remitted money. I think that that's kind of how it's contemplated at the moment. But again, some of the mechanics of how all of this is going to work, we expect to have more guidance from the SBA and or Treasury in the coming days, is what we've been told.
All right, so I know we are hitting about 10 minutes on to our hour. We had one more slide here, just more on the documentation, which folks will get to see later on. The last topic, because it was a change that I know Alison and Meredith touched on about the PPPFA, is this change to the payroll tax deferral program. So this was the component of the CARES Act that allowed businesses to defer payment of their side of the Social Security tax, and then repay that in 2 tranches, either half by the end of next year, and then any other additional amounts in 2022. One of the changes made by the PPPFA is that it actually made borrowers of payroll loans eligible to also take this payroll tax deferment. So there's an additional amount of benefit that you have the ability now to take as PPP borrowers. So with that, we are going to jump into our questions. The first question we'll go into, because we've gotten a whole bunch of questions like this. When we're talking about the amounts that we can include in our application for forgiveness, are we talking about when those payroll costs are incurred or when they're actually paid out? And, you know, I incur some 401k expenses for my employees right now, but I don't pay it out until maybe after that 24-week period.
Meredith, you want to go, or you want me to?
I'll do my best. So we're not accountants on this webinar. I'll just preface that. So the application, as stated, it's incurred or paid. I think that for the vast majority, it's going to be the date that the expenses were paid out. And so I just want to make sure I'm giving you the good information. So, you know, I think that, I'm sorry, I was looking for my application, but the expectation is that, here, I've got it. They're considered, so there's some flexibility built into when that paid out and costs incurred or paid date should start. You know, the application that came out for the forgiveness program built in an alternative period, which allows you to start your payroll period after you get your loan. So that first pay period that starts after you get your loan. But the expectation that we understood at that time was that the expectation is always that you're going to get 8 weeks of payroll. It's, even though there could be some logical leaps we all could make as to incurred or paid, and does that mean it's 10 weeks of payroll rather than 8 weeks if there's some straddling of the covered period. Based on the guidance that we've read, we think that the intention is that it's 8 weeks of payroll. Now, of course, that's going to expand out potentially to 24 weeks. And there's been some questions that I've seen raised as to whether that alternative payroll period even is going to make sense under the 24-week construct. But I fear that I didn't answer that question well. So Alison, if you have additional insight onto the incurred.
I mean, I think it's a great question. And the reason we're smiling is because we've been asked that question a lot. And it's not, to be candid, super clear. The interim final rules that came out before the Paycheck Protection Flexibility Act suggest that it's basically, it's designed to capture the idea that, put aside the 24 weeks for a moment, if you have an 8-week pay period, an 8-week period of time, during that 8-week period of time, you're going to actually make payments to your employees because the payroll period will coincide with that. Other times it will be time, you will incur that payment, but it may not get paid until sometime outside of that 8-week period. And so the idea is basically, if you were to look at an 8-week snapshot of your company's payroll, what is the amount that you would be eligible and not eligible, but required to pay during that timeline? And then presumably you're making those payments at some point close to that timeline, even if technically during that 8 weeks it's incurred and not actually paid out. That's essentially how I understand it. Now, in terms of 401k payment, I don't know enough about how you make 401k payments, but for example, if you have an obligation to make a matching contribution with every paycheck, and maybe one of those paychecks actually gets paid outside of that 8-week time period, but the obligation to make that paycheck is incurred during those 8 weeks, I would say to you that whatever the allocated portion of the 401k that's incurred during those 8 weeks is what you can claim as payroll eligible for forgiveness. Now, there's a monkey wrench thrown into all of this with a 24-week period, because in my mind, it's a lot harder to slice and dice payroll when you're talking about 6 months. But presumably that kind of thinking that we just described will apply for 24 weeks as well, which of course will take us well into 2021, but that's the expectation. I hope that that answers the question.
Perfect. So since you just touched on the 8 and 24 week question, we've got one that is there, if I am desiring to take the 24 week period, is there anything I have to do with my lender to tell them that that's the period I want to take now, or is it just when I apply for forgiveness?
That's a great question. Candidly, I don't know. I think it's lender specific. I would probably call up your lender. It's not baked into any rule or law here, but just as a matter of practical guidance, I would probably call up your contact at the bank and say, hey, we're looking at this Paycheck Protection Program Flexibility Act. Instead of reverting to the 8-week time period, we're going to use the 24-week time period. I know there's a new application that hasn't yet come out. Presumably we don't need to do anything yet, but we just wanted to check in with you guys and find out what your thinking is. I would have that conversation with your bank sometime in the next couple of weeks, just to belt and suspender it. But there's nothing baked into the law that specifies that, yeah, you need to pick up the phone right now and tell your bank you're doing this. But I would do that out of an abundance of caution, to check in and to also say, look, these are the documents that we understand you're going to need on the back end of this to prove that we're eligible for forgiveness. Have I missed anything? Just kind of the conversations you would have in the ordinary course with your bank about any loan you take out.
And I think, I think that I saw one, at least, excuse me, I'm going to sneeze, one email this morning from a bank making an actual affirmative outreach to its clients, just sort of updating them on the PPPFA. So you may want to just watch your inbox for some direct communications from your lender that will spell out how this is all going to unfold, given the constant changes.
Perfect. Looking at some of the other questions we've gotten, I would assume that exact same answer applies if for folks that have a PPP promissory note that would have to start repaying before the 24 weeks, but if they decide to take the 24 week. Another question, we've got a whole bunch of versions of this, is about the highly paid employee thresholds, the $100,000 cap. And so, the version of the, two quick parts of that question. And I think folks are confused. Is the assumption when we say that $100,000 cap, we're talking about that's just the capped amount of their salary you can include in your payroll calculations. It's not that you can't count any of their salary in. Correct. And it also only applies, that hard cap only applies to their wages, not the additional benefits that you're including in payroll costs, correct?
Yes, to both questions. Yep,
right.
Exactly, Steve.
When we talked about FTEs and calculating FTEs, we've got a couple questions about part-time workers. I assume that if I remember correctly, right, it's the added rule, 2 part-time workers equals 1 full-time worker, basically.
Yeah, there's 2 ways that you can go about calculating that. One is to do like a true hours, over 40 hours calculation. Or for administrative convenience, you could use a 0.5 for anyone who works less than 40 hours a week, but nobody gets to be more than a 1.0. So if you have somebody who works 60 hours a week, they don't count as 1.5 employees.
Okay. Interesting question here. What if during our 8 to 24 week period, we actually increased people's salaries during that time, whether it's because we gave hazard pay because of essential workers or just bonuses because people did a great job during that period? Can we include that increased pay in our forgiveness amount?
Yes, you can include bonuses and or hazard pay as part of your payroll. So one of the inconsistencies here, and this is really important, is on the front end, the Paycheck Protection Program looks at payroll. On the back end, it looks at full-time employees. So you could have 10 employees who are making a little bit more during that 8-week period than they maybe were making, you know, at the operative time that you're looking at them, say at the beginning of the year, because during that 8-week period, you had 4 of those employees going into your office and sanitizing your office during a pandemic. And so you've decided to give those employees hazard pay. If you document the reason for the bonus, you document the fact of hazard pay, you can absolutely include it in your payroll. The interim final rule that just came out clarified that. So you can do that. And I don't think it matters if technically, you know, on a pro rata 8-week basis, they're making a little more than they maybe were making at the beginning of the year on the same pro rata 8-week basis.
Perfect. I know we're hitting the top of our hour. Let me do maybe 2 more questions. So one, I think, Allison, you might have talked about this earlier on. You can also, it's not just rent or lease pay or interest payments for real estate related loans, right? You can include things for, say, company car loans and company office equipment.
That's how we read it. Yeah.
That's the personal property definition, I believe.
Yeah, so a lease on a car or a lease on office equipment would be included as a rent expense for non-real property, personal property.
Perfect. And when we're talking about, and we'll make this one our last question, when we're talking about utilities, are we talking just water, power, or can we include internet and all of the fun utilities like that?
It's broader than water and power. I believe it includes internet, and it may include transportation. I'm sorry, I don't have the list in front of me, but it's broader than just water and power. There's a couple that count for utilities as well.
We may include waste disposal and things like that as well. I think it does.
Perfect. Well, with that, I know we've hit about a minute over the top of our hour. I want to thank Allison and Meredith for their insight and wisdom today, and providing a lot of great content and great answers to questions. And hopefully we'll get some more answers to questions to folks over the next few weeks as the SBA and Treasury put out some new rules. So thank you, Allison. Thank you, Meredith, for participating with us today. Thank you to the folks who attended our first inaugural ALTA Insights webinar. Again, you will get a copy of today's webinar, including the PowerPoint and a recording as well for post-viewing if you'd like. Again, keep submitting your questions in. We'll try to get to as many as we can. And with that, I hope everybody has a great rest of your Wednesday. Thank you all.
Thank you. Thanks for having us. Bye.